Good morning, everyone. Welcome to another episode of the Mizuho Week Ahead. I'm Boon Hing, I'm economist at Mizuho Bank. This week's theme is the end? Not quite. The dollar is markedly weaker last week, with the FOMC decision turning out to be less hawkish than expected. To recap, Gooseby, the Chicago Fed president, voted for no cut, joining Jeff Schmidt, who also voted for a rate hold at the October meeting. With downwardly revised inflation projections and concerns of labor market weakening, a modest one rate cut projection in the dot plot was doubted by markets, which continue to price in 2 cuts in 2026. It is certainly hard to see the end of the Fed's dovish bias, with the Fed's attempt to ensure sufficient liquidity via $40 billion purchases of Treasury bills a month. The tariff situation is certainly not resolved, with Mexico imposing tariffs on Asian imports ranging from 5% to 50% that will take effect in 2026. China and India's exports will be subjected to these tariffs, while some countries such as Australia, Japan, Malaysia, Singapore, and Vietnam could potentially be spared as they fall under the CPTPP. Down under, the RBA's rate hold was widely expected, and Governor Bullock's attempt to take rate cuts off the table sent yields higher. That said, it remains tough to call an end to the easing cycle, as the dismal employment contraction in the jobs report reversed the increase in 3-year ACGB yields post-RBA. In Asia, as we had expected, in the Philippines, the BSP proceeded with a 25 basis point rate cut, which initially had a rather hawkish guidance that this December move may be the last cut and the easing cycle may have ended. The maybe caveat was certainly not read in its intended manner, which saw Governor Rimonora following up with an interview to emphasize that if we get off the fence, it's probably another rate cut, and that they don't see a significant growth recovery until H2 2026. For the upcoming week, the ECB decision is no surprise, amid a widely expected rate hold, as the Eurozone still faces sticky services inflation and rather resilient growth. The Bank of Japan will face a tough call, even though markets are already expecting a rate hike on 19th of December. Amid these heightened expectations, the JPY could weaken further. In Indonesia, on 17 December, we expect Bank Indonesia to push through a 25 basis point rate cut to provide further monetary policy support for growth and dovetail the current fiscal stimulus efforts. Admittedly, this easing move is enabled by a period of relative ideal stability, but depreciation risks have not abated as authorities shore up rupiah defenses with various legislation tweaks. On the same day, the Bank of Thailand is also likely to ease monetary policy settings, as economic and financial conditions have shown little signs of improvement. That said, there is a notable risk that political uncertainty may be purposely raising the odds of a whole, as the BOT may feel compelled to provide an anchor of stability. All in, even amid the substantial central bank action this week, the US NFP print on 16 December and US CPI print on 18 December imply that we are unlikely to see the end of sharp dollar volatile moves. For more information, please refer to our week ahead publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.